Hi, my name is Kristin Jamieson with Success Mortgage Partners. Today we're going to be talking about private mortgage insurance, which is also known as PMI. Anytime you're putting less than 20% down on your new home purchase, you're going to pay PMI, or private mortgage insurance. And it's an insurance policy that protects the lender should you default, that you as the buyer has to pay for. Now, there's several different ways that you can pay your PMI, or private mortgage insurance, and it's up to the loan officer to explain all of the different options. You know, everybody's so concerned these days about interest rate and why are interest rates so high, and it's the interest rate that's making my payment that high. And in reality, lowest interest rate rarely ever equals lowest payment. So there's 4 different basic ways on a conventional loan that you can structure your PMI, or private mortgage insurance. There's what's called lender paid PMI, or LPMI is what we call it. And what that does is the lender adjusts the pricing so the interest rate's going to be a little bit higher and basically pays that premium upfront for you. So you don't actually pay monthly or private mortgage insurance monthly in your payment. It's factored into the interest rate a little bit. But if you compared lender paid mortgage insurance next to the next one, which we're going to talk about, which is borrower paid mortgage insurance, the payment's always less. Another way to do it is borrower paid mortgage insurance. With borrower paid mortgage insurance, there's a little bit added to your monthly payment each month for that private mortgage insurance policy, but it will terminate or go away when the loan to value actually reaches 78% of the original purchase price. So with lender paid PMI, you have the higher interest rate for the life of the loan. With borrower paid mortgage insurance, your payment's a little bit higher, but at first, but after about 10, 11 years-ish, depending on the loan amount and your down payment, that PMI would fall off automatically, which is really nice. So there is light at the end of the tunnel to get a lower payment. Another thing you can do is pay a lump sum PMI premium. So basically you pay it out at closing, and it's based on a percentage of the loan amount. We run the PMI calculations through the mortgage insurance companies. So it would be an added closing cost, but it gets paid once, then you never have to worry about it again. You get the lower interest rate all the way through the loan, the term of the loan. But it can get costly. But one thing that buyers are doing now is they're starting to ask for more in seller paid closing costs, or seller concessions, because those seller concessions can be used to pay that lump sum mortgage insurance premium. And lastly, there's a way you can split it. It's a split MI premium. So you can pay a little bit up front, have a little bit in your monthly payment to keep the out-of-pocket cost as low as possible, and also the monthly payment as low as possible. So you kind of get the benefit of both. At the end of the day, you just need to make sure you're working with a loan officer that can accurately depict or show you all the different options, or PMI options, because that's really where the true savings over the life of the loan can come in. We've talked before about interest rates, about $25 for every 1/8%, depending on the loan term and rate. But there can be a huge savings monthly, like sometimes $150 a month, if we just change the way the PMI's factored into the loan. If you or anyone you know has any questions on private mortgage insurance or different ways to structure PMI options, please don't hesitate to reach out to myself or my team at 352-242-1535. Thanks, and have a great day.